Okay, so let's finish out our ratio analysis chapter with a look at liquidity and liquidity ratios. There are several different definitions of liquidity, two important ones I really want to focus on. First is a general definition, and that's really a measure of a firm's ability to quickly produce cash to meet its short-term obligations, which may be certain obligations or possible obligations. So here's an example of usage. In Q4 2008, then Treasury Secretary Hank Paulson outlined the Treasury's proposal to provide an unlimited amount of liquidity to Fannie Mae and Freddie Mac. He's outlining this to Congress, and he defended to Congress this unlimited allocation of cash as follows. If you got a squirt gun in your pocket and people know that, you may have to take it out and use it, he said, but if you got a bazooka, you may not have to take it out. And what he's getting at there is that he's used the bazooka, and he has told the markets, as we learned in our Fannie Mae chapter, that he is going to supply an unlimited amount of liquidity, an unlimited amount of ability for Fannie Mae to produce cash and meet its short-term obligations, like debt refinancings and things like that. So there's an example of the general usage. A more specialized definition of liquidity is the ability of a firm to quickly convert an investment portfolio to cash with little or no loss in value. And an example of using this definition we can see by looking at Bear Stearns in 2008. In June of 2008, $40 billion, as reported by the Wall Street Journal, of Bear Stearns' portfolio was illiquid, comprised of CDOs and other inscrutable stuff that no one would bid on. And this is one of the things that led to the collapse of Bear Stearns. Bear Stearns was claiming it had all these great assets. If it came in a little bit low on cash, it could just sell some of its assets and raise cash. But guess what? No one would bid on these assets, and that's pretty scary. So what did that make them? That made them completely illiquid, okay? And because, in part because it couldn't sell these things, because no one would bid on them, it ran out of cash, and it was forced by Hank Paulson, Treasury Secretary at the time, to sell itself to JP Morgan Chase for virtually nothing. Later in 2008, okay, Bear Stearns was claiming it had this portfolio that was worth $40 billion. Actually, Citibank sold a similar portfolio later in 2008 for 22 cents on the dollar. Okay, so really this was not worth anything like what Bear said it was worth. Okay, so liquidity ratios are all going to be measuring sources of cash over cash obligations. So is bigger better? You guys are pretty good at this now, so I'm going to say yes, but I'm going to qualify this up to a point, right? Because you're not you're not in the business of piling up a huge mountain of cash. Okay, and we saw that with Microsoft. We saw that with Apple, with the lawsuit that David Einhorn brought against Apple. So you want to have enough cash to cushion yourself so you don't go bankrupt if something bad happens. But no owner of the company, and even lenders after a certain point, are interested in you just piling up a big mountain of cash. Okay, so what are our sources of cash going to be? Could be our current assets. Our current assets are assets that we know we're going to convert to cash within a year. Very similar to our working capital assets, which we talked about when we looked at our cash analysis and our indirect cash flow statement. Cash flow from operations, right? If our operations are generating cash, that's a source of cash. Revolving lines of credit. A revolving line of credit is, again, for a company, very much like a credit card at a company scale. It's a loan that the company can increase whenever it wants to generate cash. Cash obligations from operations are going to be current liabilities. That's stuff we know we have to pay within a year. Cash flow into operations. If our operations are losing money, we have to put money into them. Interest obligations, got to pay our interest. Depreciation, and of course we know the answer to that is no, right? Depreciation never has anything to do with cash. And that's just what this slide is getting at. Okay, so now another term of art we're going to need for liquidity ratios is CapEx, which is short for capital expenditures. CapEx is defined to be net purchases of PPE, so purchases minus sales. And for a large steady state company, Procter & Gamble, Walmart, something like that, that's growing slowly, maybe with GDP, CapEx should be matching the decline in useful life of PPE. In other words, as PPE is wearing out, it's being replenished at the same rate. So for a large steady state company, that's going to be pretty true. Where do we find CapEx? We're going to need it for some of these ratios. We find CapEx from the cash flows from investing portion of the cash flow statement. Okay. All right, so our first liquidity ratio, current ratio, measures current assets over current liabilities. This is a nice one. This is the amount of cash that we believe we're going to generate from our assets in the next year over the amount we know we have to cough up and pay off in the next year. So that's kind of nice. And we talk about our current ratio being 1.7. And what that means is our current assets total 1.7 times our current liabilities. Just going back to algebra, bigger is going to be safer here, okay? And also, interestingly here, there's a knife edge here at 1.0. If we're at less than 1.0, that's not good. That means we know we have to cough up more cash over the next year than we have available from the assets that we can convert to cash in the next year. So that's not so good. A regulated utility can sail very close to the wind with a very small ratio. A tech company is going to want to have a bigger ratio. And how much bigger depends on the industry, et cetera, et cetera. Working capital ratio. Working capital is something, a term and a set of terms, in other words, things like working capital accounts, related terms, that are going to follow you through your career in finance, for those of you going further into finance. So the working capital ratio is going to be important. So first of all, what are our working capital accounts? We looked at this in our cash analysis chapter. all asset and liability accounts associated with the day-to-day business. Okay, if you think about the definition we gave in the last chapter, that's exactly what this boils down to. Okay, and that's going to include accounts receivable, inventory, accounts payable, prepaid expense asset, et cetera, Of course, no liabilities in here. Doesn't include short-term portion of long-term debt because that's not operating, et cetera. Okay, and I'm going to, for the purposes of saving time, also skip this. This is also in the text and you can read about it, but it's not necessary for midterm 2, so I'm going to leave it out of this. So now that we know what working capital accounts are, here is a term of art that we have not encountered yet, which is working capital. Working capital is defined to be working capital assets minus working capital liabilities. What's it measuring? It's measuring how much more cash and normal business, soon to be converted to cash assets we have than our normal business, soon to be paid liabilities. So you can think of this as an excess of normal business, soon to be cash assets, right? How many more of these guys do we have than these guys? Bigger is better, up to a point. These are all going to be up to a point. Negative is clearly not good, right? That would mean we'd have a deficit of normal business, soon to be cash assets. Working capital ratio is just working capital divided by working capital assets. And now it's measuring our excess of normal business operating assets, but just in a percentage way, as a percentage of our total normal business operating assets. Bigger is safer. Upper limit in this is going to be 100%. Okay, so we have an upper bound here. Regulated utility will have a very low ratio. Startup should have a pretty big ratio. All right, quick ratio we're not going to cover. You can look that up online. I don't even think it's covered in the textbook, so you can just Google it if you're interested. Fixed coverage ratio, very important for lenders. Lenders care very deeply about this ratio. Okay, for lenders and prospective lenders. This is defined to be EBIT over interest, and what's it measuring? It's measuring the ability of our operations to pay interest, okay? Bigger is safer, and this should be, we have another knife edge here, this always at 1.0. We always want this to be greater than 1, right? EBIT, earnings before interest and tax, is what's available to pay Jamie Dimon the interest that we owe him. So this ratio better be greater than 1, showing that we have more available than what we owe. Okay, if it's less than 1, we're in trouble. EBITDA, I promised you we would get to EBITDA. This is a term of art used in finance very, very frequently, very important if you want to keep going in finance to know what EBITDA is. EBITDA defined to be, it's kind of like EBIT, but now it's earnings before interest, taxes, depreciation, and amortization. Okay, so we have a couple new terms here. If your EBITDA in general is not greater than 0, you are totally screwed, right? If you have no earnings available before interest, taxes, depreciation, and amortization, you're pretty much in big trouble. All right, so now let's get on to some more sustainability ratios using our CapEx term and our EBITDA term. EBITDA sustainability is defined to be EBITDA over interest plus CapEx. And so this is measuring what's available to pay everything that is essential to keep the firm going, okay? And what's absolutely essential to keep the firm going? Interest. You got to pay Jamie Dimon his interest, or you got to declare bankruptcy, and capital expenditures. We have to maintain our equipment, otherwise the equipment is going to go bad. It's going to become unsafe. It's going to become unusable, and we can't operate anymore. Why have I not included tax in here? I haven't included tax because if you have a company that is just barely making it, if you have a company where this ratio is just about 1, you're not going to have to pay any tax. Your earnings before tax is going to look very much like 0, and you're not going to have to pay much tax. Okay. So once again, we have, as with all these ratios, bigger is safer. And once again, we have this knife edge at 1. Okay. And I promised you we would be talking about interest rates. And here we have an interest rate ratio. It's called the nominal interest rate ratio. And it's simply our interest expense annualized divided by our total debt at the beginning of a period. And it's just telling us how much a firm pays for its debt financing. Okay, low is good, high is bad. You want to have a low interest rate. Decreasing, if all things are equal in the macroeconomy, is good. Increasing, if all things are equal in the macroeconomy, is bad. Depreciation test is depreciation over CapEx. This is a ratio that lets you know about the ongoing health of a company. If a company's depreciation is much greater than their CapEx, then clearly they're underfunding their capital expenditures. They're letting their machines wear out. For Continental or Southwest, this would be a huge disaster, okay? It would mean that they are not maintaining their planes, and their planes are in danger of becoming unsafe, okay? And for a fast-growing company, we're going to typically find the depreciation test is less than 1, and that's because you're growing, you're buying more equipment in any given period than you have a lot of depreciation for, okay? And as I said up above, companies in trouble often have depreciation tests very big, and it means they're underfunding their CapEx, and that's sort of cause for trouble, cause for alarm. Okay, so let's look at Continental and Love and think about some of their liquidity ratios. Based on TTM results, which company best plans for its near-term obligations? Well, I'm gonna say that we want to look at the current ratio. Current ratio has those current liabilities. That is our current obligations. Okay, and look at this on a TTM basis. Continental looks better. It's got a ratio above 1, and Love doesn't, which is a little alarming. Okay, so let's go here and put in Cal from current ratio. Is the other company unsafe? Love has CR less than 1.0, but I'm not worried about Love at all. Love has just looked so good throughout all of this analysis. It may have a revolving bank loan, which of course doesn't appear anywhere in the financial statements, a portion of that loan that hasn't been drawn yet. It also has many long-term assets like planes, gate leases at airports. It could sell to generate cash. Okay. And is the trend in Continental's EBITDA sustainability ratio good or bad? So let's find that EBITDA sustainability ratio. Here we go. And we're looking at Cal. Okay, so it's EBITDA over interest plus CapEx. So we want this to be greater than 1. Okay, greater than 1, greater than 1, greater than 1, greater than 1. Bouncing around, right? Very, very volatile. Less than 1, less than 1, less than 1. Not good. So the trend is bad because the ratio is getting lower. So we want to say, is the trend good or bad? The trend is bad because the ratio is decreasing. Okay, and are the recent levels of this ratio sustainable? No, because they're less than 1. All right. Assuming Cal's debt is all of the fixed rate variety, I'm going to say that one we don't have to worry about. And I'm also going to say this one we don't have to worry about. I'm going to try and keep the questions very simple and straightforward on midterm 2. How has Continental's management of its capital expenditures improved over the past 3 quarters? Why or why not? Let's take a look at that one. So for this one, we're going to want to look at depreciation test, and we're looking at the past 3 quarters. So let's look at what this ratio is made up of. Depreciation in the numerator, CapEx in the denominator. So this is one that we don't want to be 200% or something like that. That would be bad, and you can see it's been greater than 1, which is not so great. But in the past few quarters average, you can see what it looks like to me is they were definitely underfunding their CapEx here, and they realized that, and they started trying to make up for it here, holding their own here, and make up for it here. So now with that in mind, let's see what the specific question is. Has it improved over the past 3 quarters? So we want to give a resounding yes. As we see in the depreciation test, CapEx relative to depreciation has increased. Okay. And that's about it for this chapter. So what we have here at the end of this chapter is Continental's financial statements, all the financial statements that I use to create all the ratios that we see in this chapter. So any ratio you want to check, use this information. Make sure you can duplicate all the ratios. I think they're all correct. There might be some mistakes here, but definitely if you want to check out any ratios, here's where you want to go to do that. Okay, and that's it for this chapter. That will wrap it up.